Since the Great Depression, most U.S. recessions have followed the Federal Reserve interest rate increases. The subsequent recession has frequently led the Fed to reverse direction and begin decreasing the federal funds rate. Rapid rate rises are the most likely central bank reaction to strong inflation, which may have been driven by prior looser monetary policy. There is no one-size-fits-all definition of how fast is too fast, and there's no way to determine if policymakers made optimal trade-offs between growth and inflation unless in retrospect. The U.S. Federal Reserve raised interest rates again on Wednesday as expected. The Federal Reserve maintained its anti-inflationary stance by increasing its benchmark interest rate to its highest level in 15 years. To make matters worse, the Federal Reserve of the United States remains doggedly aggressive and hawkish, signaling that further rate rises are expected next year. The Fed is raising interest rates at one of the quickest rates in history. The Fed forecasts that the U.S. economy will grow by 0.2% this year. When the Fed raised its rate target range by 75 basis points in June 2022, it was the largest rate boost since 1994. The 1994 hike was part of a tightening of monetary policy that saw the Fed's fund rate double to 6% in a year. Nonetheless, GDP growth in the United States increased from 2.8% in 1993 to 4% in 1994. After falling to 2.7% in 1995, economic growth increased to 3.8% the following year. It was perhaps the Fed's only easy landing in the past 50 years. If the resemblance is still appealing, remember that inflation in 1994 was 2.6%, compared to 8.6% in the year through May 2022. Unfortunately, I know of no theoretical framework that can tell us how much we will need to tighten long real rates to get inflation back to target in a reasonable time frame, Minneapolis Fed President Neil Kashkari wrote in June 2022. Kashkari projected that by hiking the Fed funds rate from near zero in early 2022 to a range of 1.5% to 1.75% by June, the Fed had accomplished roughly half the tightening of 1994 compared to the neutral Fed funds rate. He did, however, mention the disparity in inflation, implying that the Fed may need to tighten more than it did in 1994 to get it under control. Similarly, Kashkari claimed that the Fed's hard-earning credibility on inflation would prevent a repetition of the late 1970s and early 1980s. A significant recession developed as the effective funds rate jumped from 4.7% in early 1977 to more than 19% in periods in 1980 through 1981 due to excessive inflation. For a year, the unemployment rate was close to 10%, and it had been rising for years before and after. So what does this mean? Will America face another Great Depression? And will this lead the American economy to collapse? U.S. Federal Reserve Chairman Jerome Powell stated that increased interest rates would surely cause discomfort for American businesses and households, particularly middle-class couples paying off a mortgage. Nevertheless, the Fed is determined to combat the country's rising inflation. To prevent dollar-denominated assets from being pulled back to the U.S. by the Fed's aggressive rate hikes, other economies will be obliged to raise interest rates as well, resulting in a worldwide recession and the loss of hundreds of millions of jobs. It's no surprise that an increasing number of economists are speaking out against the Fed's reckless and irresponsibility in hiking rates so rapidly. For example, following the Fed's rate hike on Wednesday, the depreciation of the world's major currencies, including the euro, British pound, Japanese yen, Indian rupee, and Chinese yuan, has accelerated. For instance, for the first time in 24 years, Japan's central bank was compelled to intervene in the foreign exchange market by purchasing back yen in order to keep the yen's value from falling below 145 yen to the dollar. Meanwhile, the euro has fallen roughly 15% against the dollar this year and is trading below parity. The yuan has also suffered as a result of the Fed's policy tightening, reaching a 26-month low of 7.08 yuan per dollar. And at a time when the Ukraine crisis is becoming more complicated, adding to the uncertainty that could further disrupt global energy and food supplies, the Fed's aggressive rate hikes could further deteriorate the global economic outlook. There is a genuine possibility that another financial storm or system-wide disaster is on the way. Faced with the aftermath of the 2008-2009 financial crisis, the Fed resorted to a long cycle of monetary loosening known as quantitative easing, or QE, in which printed dollars were dropped into the hands of American businesses and individuals to spend. Prior to 2008, the Fed's balance sheet was less than $1 trillion. By 2015, it had grown to $4.5 trillion, It was nearly $9 trillion at the end of 2021. And in order to keep the U.S. economy afloat in the aftermath of the COVID-19 outbreak, both the Trump and Biden administrations turned to extremely generous financial stimulus spending programs, one after the other. These splurges by the Fed and the White House caused the U.S.'s runaway inflation. To combat persistent inflation, which has become entrenched in many economies, central banks all around the world are increasing interest rates, suffocating economic development. Almost all global and regional research institutions have considerably reduced their global economic growth estimates for 2022, with many extending to 2024. Some economies are unlikely to see an increase in growth until 2025, and this bleak outlook is causing concern among many people throughout the world. Meanwhile, while the Fed pursues a soft landing for the economy, decreasing inflation to 2% without causing a recession, many people are concerned that a great collapse is on the way. Many experts believe the bank's benchmark federal funds rate will continue to rise throughout next year until inflation returns, with CFP Kimberly Howard predicting a long ride and a lot of pain ahead. The stakes are high and the timing is crucial. If the Fed raises interest rates too quickly and too high, it risks cooling demand to the point where the economy enters a recession. Higher interest rates make the debt more expensive and borrowing more difficult for both people and businesses. Everyone will be spending less money, and some individuals will be unable to obtain the funds that they may require to continue living their lives as they are. This might result in widespread layoffs, stock market pressure, and financial suffering for millions of Americans. Many people believe the United States is already in a recession, even if it isn't officially declared, and are bracing for the worst. Apple and Google have already declared plans to cut hiring. Other companies have declared layoffs. The labor market was still near a record high in August, but unemployment analyst Andrew Stettner predicts a poor job market a year from now. The job market is a lagging indicator, Stettner says. Right now, things are fine, but it will slow down. Investors tend to panic when the Fed takes aggressive measures, resulting in increased market volatility. The stock market is expected to see additional negative pressure in the coming weeks and months, but the Fed's move to raise interest rates should not derail your long-term investments. Zooming out, historical data demonstrates that the stock market always rises with time, and the best-performing portfolios have the most time in the market. With that in mind, the wisest course of action is to keep going and continue investing if you still have a long time before you want to retire or achieve financial independence, regardless of what the market does. If you're nearing retirement, you should start thinking about switching to more conservative assets and determining the optimal time to use the cash in each account or plan. Follow the 4% rule, which recommends withdrawing only 4% of your retirement savings in the first year and then adjusting for inflation in subsequent years. According to experts, if you follow the rule, your nest egg will likely endure at least 30 years. Prioritize low-cost, broad market index funds as the most effective approach to accumulate money over time, and always keep a long-term perspective in mind. It is important to have good timing in monetary policy. The economy must be strong enough to withstand the increase in borrowing costs caused by rising interest rates. If the Fed tightens too quickly, it risks sending the economy into an unnecessary and deep recession, as happened in 1937 through 38. So far, the most notable impact has been in the housing market, which has experienced a dramatic collapse as mortgage rates recently soared to their highest levels since 2008. However, experts believe that the entire impact of the Fed's inflation-fighting campaign will become obvious in the coming months. Even if the labor market remains strong, rising interest rates might lead to more unemployment and fewer job possibilities in the long run. What happens next remains to be seen.